There's a sentence your banker has probably said to you, your financial advisor too, maybe even your parents. Put some of it in bonds, it's safe. Today, we're going to find out if that's true, or if it's the most expensive piece of conventional wisdom in modern investing. Welcome. This is episode 1 of a 4-part series on government bonds, what they are, what they've actually returned, where they've failed spectacularly, and whether they belong in your portfolio at all. Let's start at the beginning. What is a bond? A bond is a loan. That's the whole thing. You lend money to a government, the United States, Germany, Switzerland, or a company, and they pay you a fixed annual interest rate called the coupon. At the end of the term, 5 years, 10 years, 30 years, you get your principal back. Predictable, structured, boring. That's the appeal. And for decades, financial advisors built prudent portfolios around the idea that bonds balance out the chaos of the stock market. The famous rule, 60% stocks, 40% bonds. The 40 is your seatbelt. But here's what the brochure leaves out. The price of a bond in the open market moves in the opposite direction of interest rates. When rates rise, bond prices fall. And when rates rise fast, bond prices fall hard. A 30-year Treasury bond can lose 30 to 40% of its value if interest rates climb by just 3 percentage points. That's not a footnote. That's the most important sentence in bond investing, and it's the one most people never hear until they have already lost money. And this is exactly the kind of analysis we go much deeper on with our community on Patreon. If you want to know more about how to manage your finances, with in-depth reports on economics and geopolitics that go far beyond what a 5-minute video can hold, join us on Patreon. Link is in the description. Now, back to bonds. Let's go back to January 2000. You're a careful investor. Tech stocks are terrifying you. You choose bonds. Here's what you could lock in. US 10-year Treasury, 6.0%. German Bund, 5.3%. Swiss Confederation, 4.1%. Solid. Respectable. And the first decade treated you reasonably well. Rates declined. Bond prices rose. Your fund looked healthy. Then the world changed. Central banks went to zero, then below zero. By 2019, the German Bund 10-year yield was negative. You were paying Germany for the privilege of lending to it. Switzerland set the all-time record, 0.8% on its 10-year bond in 2020. Lend to the Swiss government for a decade, and you were mathematically guaranteed to receive less back than you put in. That's not a safe haven. That's a guaranteed loss with a government letterhead on it. So, what did 25 years of holding AEA government bond funds actually return? We'll go through the full numbers in episode 2. Nominal returns, real returns after inflation, and the number that's going to change how you see everything. What a simple, boring global equity index fund did over the exact same period. But I'll leave you with one question to sit with until then. If the safe asset can go negative, can lose 35% in a single year, and can underperform inflation for an entire decade, what exactly is it protecting you from? Subscribe to Curiosity Matters, the link is right below, and join a community of people who refuse to take financial conventional wisdom at face value. And if you want to go even further, in-depth analysis on economics, geopolitics, and how to manage your finances with real clarity, join us on Patreon. The link is in the description. We'll see you there. See you in episode 2.